Tonight, we say goodbye to 2025. The good, the bad, the indifferent, the outrageous, all the crazy things that happened this year, the unexpected things. We'll go through them and look forward to 2026. What do we see here at CB3 Financial for your portfolios? How is the Fed going to affect it? How are earnings going to affect our portfolios? How's the midterm elections? So many variables. And the third segment, risk management for 2026, how much more sophisticated it has gotten since we have moved our clients to Schwab. It's Thursday, December 11th, live from Chicago. I'm Charles Brown, your portfolio manager, and this is CB3 Live. Well, I hope it is. Well, it's been one of those years now, hasn't it? Okay, might as well affect our production set here in Chicago. So, hope you guys are ready for an exciting night. We have a lot of material. We're going to look back distinctively at 10 specific areas of the things that move the markets this year, and then 10 possible things that will move the market in 2026, and then risk management. So stay with us, so much to go over. Santa Claus is gearing up, and I hope is going to stop at your house. We're going to examine how the markets defied expectations with the S&P 500's resilience despite economic headwinds, breaking down the disconnect between Wall Street and Main Street, Fed rate decisions, one of which just happened yesterday, and sector rotations that caught many traders off guard. Second, we're going to explore the key catalysts that could drive portfolios higher and trigger corrections. Now, obviously, we don't want to have a big correction ever, but they're inevitable. They have to happen. They make the market stronger, so we need to position for it. What's the Fed's evolving stance? Earnings, sustainability across mega cap stocks versus the broader segments, and geopolitical factors, everything going on. And we're going to further detail. We've been talking about this since August, on and off. We're going to sum it up tonight and actually get ready for another segment on this in the January show. So here we go. Look at these bulls all here and excited. More stellar artwork from our designer, Heidi Steiner. Thank you, Heidi, for 7 years of graphics. We start our 8th year together next year. Number 10, we'll do the countdown here, a la David Letterman. The China-U.S. tariff negotiations. So throughout 2025, ongoing trade tensions between the U.S. and China created persistent uncertainty for global supply chains. And obviously this means all the items that are shipped back and forth, mainly though importing here to the U.S. from China, and that uncertainty is what has made the markets really jumpy this year. In May, there was a 90-day temporary deal signed on U.S. tariffs on Chinese goods to 30%, Chinese tariffs on American products to 10%. Again, the Chinese need us way, way more than we need them. They would never admit that, but the reality is they do. Their economy would crumble without us. Ours would be affected, but not crumble. And these negotiations set the stage for the year's most dramatic market event. So we're starting with this at number 10. And when we finish at number 1, you'll see where this last sentence comes into play. Here's what it looks like on the chart. So US tariffs, 30%, China tariffs, 10%, and then the timeline at the bottom. So May 12 was the temporary deal, the 30%, and the China tariffs at 10%. That 90-day relief window, and this has just gone back and forth, and this foreshadowed the April Liberation Day crash of April 2nd, which is going to be down the road here. You'll see in this review section. Number 9, DeepSeek AI interruption. It almost seems like ancient history because so much is happening with AI and so quickly. But on January 27th, now almost a year ago, The Chinese startup DeepSeek sent shockwaves through the markets by unveiling an AI model rivaling ChatGPT. And keep in mind, this is when Anthropic barely had Claude out there, and Grok was very brand new, and Copilot from Microsoft was pretty brand new. But they did this, DeepSeek did this for $5.6 million versus hundreds of millions for US competitors. Now, in today's language, nobody's spending hundreds of millions developing an AI engine. They're spending tens and maybe 100 billion doing it. Probably not 100 billion, but certainly tens of billions doing it. But back then, when this news came out, it caused NVIDIA to plunge 17% in a single trading session. So that's like 7 hours for the US, losing $600 billion in one day, the largest one-day loss in stock market history. Now, we must note that they did bring that back throughout the year, and you're going to see why as we go through these segments. But that was shocking at the time. The event challenged America's perceived AI dominance and raised questions about massive investments in the AI structure, and that continues to this day and will be another one of the segments covered in this review. All right, so that's number 9, DeepSeek on the left, 5.6 million. GPT, OpenAI, but obviously you know it by the name ChatGPT, 80 to 100 million to develop. Way more than that now, but back in January, again, 10 and a half, 11 months ago, that's how fast things move. And the single day drop from NVIDIA, again, largest loss in history. Number 8, the energy sector volatility. So the volatility whiplash, and whiplash is when the market starts to go in one direction and then jerks and goes back in the other, and then jerks and goes back in the other, sort of like a fish trying to get off a line on a fishing line, right? So this early strength driven by the AI data centers power. So we needed energy to do that, right? We still do. But it reversed sharply after DeepSeek's efficiency claims because it seemed at the time, again, this is less than a year ago, that we weren't going to need these super high-powered data centers. Well, that turned out not to be true, as we well know. Constellation Energy dropping 21%. Vistra, we actually had a great trade in Vistra and then a losing trade in Vistra because they were so volatile. And it's unusual seeing stocks in the energy sector being as volatile, and some of these in the utility sector, neighboring, if you will, similar to the energy sector, energy and utilities. But this kind of volatility just unheard of in these lower growth sectors. And by year end, the sector ranked among the worst performers, even though it had multiple 2 weeks periods where it led the market. And that leads us into this next section. What's the number 7? Well, first, let's look at this. Early 2025, the data boom. Obviously, it's looking like energy is going to go crazy, but then DeepSeek comes out, maybe doesn't need as much carbon fuel, and so that killed the rally. Constellation Energy, you saw these numbers on the previous screen. Energy worst 2025 performer. It didn't start that way, but that's how it ended. The sector rotation, number 7 on my list, the sector rotation whiplash. Now, normally when a sector is having a strong year, it stays that way for the majority of the year, meaning 6 to 8, maybe even 10, 12 months, could be the whole year. But this year, there was not a single sector. Look at this second line. Not a single sector, but held the number 1 position for more than 2 weeks at a time. Energy led for 3 separate 2-week periods, yet finished among the year's worst performers, as I just mentioned. Healthcare surged during the October shutdown because it looked like there was going to be some volatility, and the Obamacare, ACA obviously coming back. So that got on fire as the government was shut down for 43 days. Tech dominated, then crashed, then recovered. Jeez. All right. This rapid rotation frustrated momentum strategies, and that would be us. All right. This was difficult for us in CG and GI and DS, all 3 programs this year, because once we get on a momentum trade, we want it to stay with us. Now, that happened last year in 2024, as you probably remember, those of you that are clients, 29% in CG, 34% in DS. But the market just couldn't deliver that this year because of this volatility going backwards and forwards. So the different colors here show you. So tech is blue. We have financials at yellow. We have energy at orange. and then healthcare at green. And every single month there's a different leader. It's really hard to get a sustained trend. And that's why we end up trading around looking for the leaders, because most of the time leaders stay in place for 3 to 4 months. And we're happy to have a trade that makes a 15, 18% return in 6 months. I mean, that's annualized at 36, folks. That's a great return. But it just did not play out that way this year. You can see in the right-hand corner, the year-end rank was worst in 15 years as far as sector whiplash. So I'm hopeful that 2026 is going to go back to the proclivity, if you will, of sectors staying in the lead a little bit longer than normal. Another concerning issue is the Magnificent Seven continuing to concentrate. So I have this in red because the Magnificent Seven represents 45% of the S&P 500's weight. Just get your hands around that. S&P 500, it's not the S&P 50 or the S&P 25, all right? It's not. It's 500 stocks, but 7 of them represent almost half of the entire S&P 500. Apple, Microsoft, Nvidia alone command a combined market value of $10+ trillion. Those 3 stocks are bigger than all but the top 6 economies in the world. It's just astounding what's happening here in the tech and AI sector. So while this concentration powered index gains, it also means that single stock events like Nvidia's drop create outsized portfolio impacts. Read that as outsized portfolio hurt. When Nvidia went down like that, it definitely affected us in DS because at that time, Nvidia had a 14 and justified a 14% weighting. And it was a rough April. For those of you with your DS accounts, you will likely remember that. So there's what it looks like on the graph. Mag 7, almost 50% of the entire S&P 500. Why? Look at the market caps of the Magnificent Seven on the right-hand side. $22 trillion and growing literally every day. $22 trillion in the Magnificent Seven. We tend to throw Berkshire in there because it's also a $1 trillion company. It just seems like a good fit. So our Magnificent Seven in DS is really Magnificent 8. So this concentration risk is something we really have to watch out for in 2026. So the government shutdown is number 5 on our list of important events for 2025. So from October 1st through November 13th, the longest government shutdown in U.S. history created an unprecedented data vacuum. Critical economic reports, including the October job numbers and CPI, were delayed or never released. Now that's important. We're never going to see an October jobs report. We're just not. All right. We didn't have the job report in December because they didn't have the November date. So we're not really going to see a really good solid number for employment until the first weekend in January. All right. And that's super important because that's obviously the holiday season. So expect that to be a really tumultuous day on the markets. All right. The Fed made rate decisions while flying mostly blind, forced to rely on private sector data. Markets actually rose during the shutdown, but the information void complicated Q4 planning. So what does this look like? All the question marks: the October jobs report, October CPI, retail sales, import-export data, consumer spending. The Fed is flying blind as far as making rate policy decisions. And when that happens, confusion will be their epitaph, right? To quote King Crimson. All right, lots of confusion because when you don't have the data, you're flying blind and it's just a best guess. And then when the data finally is published, as I said, we're going to get a full slate of data that first Friday in January. There could well be some big surprises. It's not going to be a day I'm going to look forward to. I will be at my desk probably at 4 a.m. on that Friday morning. So the markets rose, as I said, in the shutdown, and that's good because, again, we are still in a secular bull market. Number 4 on the list, the S&P's resilient comeback. So despite a 21% bear market, which was a plunge from mid-February to early April. And this is because of, go back to the earlier part of this. If you guys are watching this twice, it'll ring true to you now. The China-US tariff issues, that's what first started this market decline. All right, the index set multiple all-time highs, though, in the final quarter, the one we're still in for a few more days, trading above 69.50 here in December and actually over 7,000 for a while and then selling off from there. But this remarkable recovery from a 21% drawdown to double-digit gains vindicated investors who stayed the course and bought the April lows. We actually had to take protective stops in April because we don't know where the bottom is going to be. And many of our clients are not in their 40s and 50s anymore, but they're in their late 60s and 70s. And you don't want to see a 50 or 55% drawdown like we had in 2008. We don't know, especially when such radical trade policies are going into place, what that's going to be. What we have done is hone our risk protection. We'll get to that in the third segment. So what it looks like on the chart, you can see the downturn there. April 2nd was the low of the year. It bounces up from that, bounces up from that. The comeback 38% roughly as of yesterday. It hasn't ended yet. It says ended on the screen, but it's not ended yet, obviously, until December 31st. But there you go. Resilient despite chaos. To me, when I see resiliency in the midst of chaos, that tells me that the underlying tone of the market is very, very bullish, and there is plenty of dry powder on the sidelines, and that is good for us as we remain fully invested in all of our programs. Number three, the Trump inauguration and policy uncertainty. Well, it started with John Roberts trying to swear President Trump in, and he hadn't even put his hand on the Bible yet. So it was kind of an inauspicious start, all right? But then the minute he got in, what were there, like 150 executive orders in the first 2 weeks? So they hit the ground running, all right? From tariff threats, immigration enforcement, now we have bombings of Venezuelan boats out in the Atlantic. It's just been a really geopolitically crazy year. The markets rallied initially on pro-growth expectations, but then crashed on this tariff implementation because it seemed like it was mercuric. And the reason it seemed that way is because it was mercuric. All right, we literally could not know. And this is why we had to change our whole risk management strategy to fit the current environment and, frankly, to fit the current administration. We'll get to that in the third segment. All right, so this choppy trajectory we had to deal with, this is what it looks like. He goes into office. We have trade uncertainties, immigration uncertainties, regulation uncertainties, fiscal uncertainties. There's a bull case. Hey, he's pro-business. He's a deregulation guy. He's a tax cut guy. That's all great. The bears say, look, there's tariff war fears, there's inflation risk, and there's global instability. So far, folks, the bulls are winning this. But I assure you the bears are not giving up, right? They're just definitely not. So volatility spiked around the inauguration, and it's been fairly low since then. Even with this last couple weeks ago, the VIX didn't go higher than 23, and that's not really high. So number two, the Federal Reserve's dovish pivot. It took them long enough after holding rates steady through August at 4.25, at 4.5. Remember, we have a range now in the Fed fund. It's kind of tricky to do this. We have a bid and offer, so to speak. It's much easier if we just declare a rate, but the trades never actually occur at one rate. It's either the bid or the offer, so that's why they're doing it. So they pivoted with 25 basis point cuts in September, October, and December, bringing rates now to 3.5 at 3.75. So this easing cycle, this is called an easing cycle. I'll show you a graph on this in just a little bit. Driven by labor market softening and confidence that tariff-driven inflation was transitory, provided critical support for equity valuations, and that is why we are just a skosh, southern word for you there, a skosh away from lifetime highs in all the indices. Russell 2000 actually hit a lifetime high earlier this week and then fell back from it, but we are right there despite everything that's going on here. This disagreement within the FOMC, remember, there was a 3-dissent vote, 9-3. First time that's happened in 8 years with the Federal Reserve. Here's what it looks like. You can see the steady reduction, and now they're saying it's probably going to stay here for most of 2026. but that is always data dependent. If we start to see additional layoffs, if we start to see that there's possibly a recession, the Fed will continue to drop rates. The number one story here it is, the crash of April 2nd, 2025. We got stopped out of a lot of positions, again, because we had a risk management strategy that had previously worked but was not prepared for Donald Trump and the data that was thrown at the world through the tariff tantrum. So it triggered this year's defining event on April 2nd and caused the most significant global market crash since February, March 2020. Trump's sweeping tariff announcement sent the S&P 500 plunging that 21.4, which I've mentioned just within weeks. NASDAQ entered a correction, and then came the dramatic reversal on April 9th, an 11.5-point single-day rally. And it was tough for many of us in the asset manager because we were positioned for safety. And then just overnight, when he said, never mind, we're not really going to do this, just 7 days later, 7 trading days later, we had to scramble. We had to scramble and get back in fully exposed. We did right away. We were fully back in the market way before the end of April, but you're still playing catch up, and that's the struggle. Nonetheless, we did protect. That's what our job is to do, is to protect your capital. So the S&P turned positive for the year on May 13th and stayed that way. So this crash and recovery cycle set the tone for 2025's unprecedented volatility, and I say with it, good riddance. I'm glad the market's going to probably, it looks like, end up for the year, and all our portfolios will gain some. Not as much as I would like, certainly not as much as last year, which was a phenomenal year by any definition. But that's what the year brought us, and we had to work with what we had. So I'm going to get a sip of water. I'm going to look in the chat box, see if I can answer any questions, and we will move on to, actually, I want to show you this chart so you can just see Liberation Day. Remember that April 2nd, because that was a really big deal. VIX went to 45. Those of you that have been watching the show know that 45 is just, you just want to get out of it. It's like a Cat 5 hurricane, all right? Wealth lost $9 trillion in hours, probably 4 to 5 hours, and a bear market for 41 days. But that's the fastest one since 2020, which of course was the healthcare COVID crash. All right. So the market preview, let me get a sip of water and look in the chat box. I see Leo. Welcome, Leo. I see Debbie Demogowski. Welcome. I see an address I don't recognize. Socket 1. Hi, welcome. Glad you're here. Let us know who you are. Hi to Debbie in South Dakota. What do you got, Leo? What's going on with you? There's how much of S&P 500 Mag 7 are owned by overseas accounts? That's a great number. I don't know what that number is. Great question, Leo. Is there a historical trend to that ownership? You know what? That's a great question for me to have answered for you by the January show. That's really good. I would think that international accounts focus on tech and AI because the markets are so deep here. Hey, Kay, how are you? There we go. Good to see you. Hope you and Gene are doing well. Appreciate you watching. Guys, what is up in front of us for 2026? Let's give it a look. The China-U.S. trade detente or escalation. So detente obviously is making peace. Escalation would be doing just the opposite. Will diplomacy or will new tariffs emerge? That's really what's in play here. So the detente path, gradual tariff rollback. I mean, I know Trump says he likes having the tariffs and all the income, but it still isn't an ideal situation. What you want to do is use it as leverage to get better trade deals. And frankly, they haven't come as quickly as he thought that they would, and maybe even as quickly as some of the rest of us thought they would. But globally at stake, all right, $7 trillion in trade risk. All right, when our economy is only 30 trillion, that's 25% of our entire economy hinging on these global supply chains. And so we really need to find some peace here with the Chinese because they're the second biggest trading entity in the world. They're our first biggest trading partner, although we actually do more trading with Mexico and Canada, but certainly they have unique offerings in the tech field that we need. We really need. So All right, number 9, AI investment hits $50 billion. Will it continue? That's why I've got the word mania in there. So the tech giants are pouring unprecedented capital into the AI infrastructure. NVIDIA, Microsoft, Google, Amazon, combined CapEx equals $500 billion. Remember in the first or second slide of the review when I said ChatGPT, they had invested $100 million? That's nothing. That's nothing. Just 11 months later. That is how incredibly fast this is moving. This is moving right now. It's just crazy. Is it a bubble? Well, if we're still producing profits and you're still seeing earnings producing profits, right? So this 500 billion gets broken down with Microsoft at 80, Amazon at 75, Google 75, Meta 65, NVIDIA 50, and then all the other tech firms at 155. So this is the 50 billion or $500 billion question. Will AGI, we're going to get to that in just a minute. Remember that acronym, AGI, justify this spending? Will the productivity gains continue to develop? Will the data center demand be insatiable? Because if they're spending all these billions, not hundreds of millions, billions of dollars, tens of billions, creating these data centers, will the appetite and the need for them continue to be insatiable? Or are we in bubble territory? That's what the bear argument is. And, basically we could be back to the dot-com era. That is unlikely because the dot-com era, as many of you know who were old enough to remember at the time, the reality of that era is there were no earnings. There were companies that had a website, no sales, and they were trading at a 30 multiple until the bubble burst, right? But right now we have real companies with increasing sales because they're finding increasing markets for what they're producing. Number 8 in the countdown for the market review, all right? Or preview, I should say. Pardon me, guys. All right, number 8, election midterm curse. So as you likely know, the party in power loses seats and often loses control of the 3 branches, so House, Senate, and the presidency. Trump has had that. He had that in 2017. He lost that in 2018. And so did Obama, and most presidents do, right? All right, that's just the way it is. So if he manages to keep it, his legacy has a much greater chance of continuing. But right now, the polling does not look that strong. We'll get to that in just a second. So the average S&P stock will only gain historically about 3.8, let's call it 4%, versus 10.8% in midterm years. All right. So this slim House majority is at risk, and even the Senate is at risk. And that's important because it affects what? Everybody should know this answer. The confirmation of Supreme Court justices. You have to have a majority in the Senate or you can't get anything through. So right now, Republicans have a 53-47 with a tiebreaker in J.D. Vance, the vice president. I don't think that they're going to pick up any seats. They would love to keep, every one of those and not lose anything. We'll see if that happens. Market implications, uncertainty throttles investment, and we don't want that. We want people to be confident in these markets. So when the polls get a little more solid, that'll be, at the end of the summer, we're not going to see anything. Anything that's in the polls right now doesn't matter at all. So end of the summer, definitely by the middle of September, it will matter. Number 7, market valuation crisis. So the Shiller PE ratio above 30. This has been a flawless predictor of 20% correction since 1871. And the challenge we have is that the bull case is, and this should be 5,000. There's a 0 missing, but in all the slides we do, it's tough, guys. Sorry. So 5,000 to 8,000 bear case, 5,000 to 4,600. Most Wall Street forecasts, though, are in the 7,500, 7,800 range, which is definitely higher than where we are today and even past the highs of earlier this year. So that bodes well if you just look at what Wall Street is predicting. So again, the bear case, we're going to be down 33% because there's going to be a valuation reversion to historic norms. Well, Bears, you have to make a plausible case from that. The reason that these companies are so in demand is because this is a new frontier with AI, especially with AGI, which we will get to in just a moment. All right. Forecast for the bulls, the consensus about 7,500, bull case 8,000. Man alive, if we're at 8,000, you guys are really going to be smiling this time next year. Those of you that are clients, because we are definitely positioned for growth. All right, the bulls say this time is different. AI is a new paradigm shift. I tend to believe that. Earnings justify valuations. The bears say, yeah. Famous last words. The math doesn't add up. Well, I remember again that 2008, 2009, all of this internet, that was more like 2000, 2001, tons of internet companies. They had nothing. They had nothing but fumes, and they're trading at 35 times earnings. And then when that all got exposed, it crashed, right? But that's just not the case now. Not the case. Number 6, Fed rate pause at neutral. And that's really what the Fed is saying right now. We're just going to pause here for probably most of 2026. Elevation is still elevated. So, we're not going to drop this down to 2.5. And no more aggressive cuts unless a recession hits. So here's how it looks. The neutral area here is this 3 to 3.5. Well, right now we're 3.5, 3 to 7.75. We're not going to see anything lower than that, in my opinion, in 2026. We don't need to go lower than that. If that even brings home mortgages down to 5.5 from 6.75, that's huge. That's huge for builders. It's just huge for the economy. Is it as nice as the 2 5/8 I had when I lived in Nashville? It is not. All right. But those were science fiction rates. Okay. So if you're waiting around for that, probably not going to happen. But again, mid 5s by the end of next year, definitely doable. All right. If inflation stays sticky, you see the red there, that's the bearish case. But if the economy remains stable, that's in green. GDP stays about 2.5%. That's a great thing. That's the environment that we want. So here we are. The AGI race accelerates. Industry leaders predict 26-27. The artificial general intelligence, AGI, Elon Musk, Dario Amati, Anthropic, which is Claude if you use that like we do. Sam Altman, of course, ChatGPT, betting on near-term AGI could transform every industry overnight, they say. So let's look at this. What is AGI versus AI? So today's AI is narrow, specialized, one task, narrow focus, limited transfer, human designed, and therefore requires human programming. Here's the big point on the right-hand side. So AGI on the right-hand side, any task that a human can learn AGI, which is general artificial intelligence, okay, has a broad understanding of multiple domains simultaneously, full transfer, applies knowledge across many different fields, and is self-learning, self-teaching. So once you start these, you just walk away and they are learning and they report back to you. They meaning these huge towers of mainframes that are producing all this data that you've programmed it for. So the key distinction is like a brilliant specialist doctor who only knows one disease, whereas AGI is like a human who can be a doctor, lawyer, engineer, artist, and learn new skills. You're going to see music being composed. We have one viewer on this call I know who has sent me a country western song which was totally generated by AI, and it's really bugging the whole industry of pop music and country music, because you got these songs that are being created, and who's getting the writing credit for it? Well, are they union? Lots of ethical questions here. So why should we care? Well, we as investors need to know where the main improvement is going to be in these specific areas, and we want to follow that money trail and invest there, and then hope a trajectory builds up, unlike the sector issues that I mentioned earlier in the program. And we realize that this possibly, as you can see at the bottom, could disrupt every industry. We've never had anything like this. It's literally like a Cat 5 hurricane that just comes to town, and you really have no idea what's going to be left when it's done. I'm not going to fear it, but I have to say, the news cycle is going to get really quick here. Like maybe weekly, we're going to start seeing major Nobel Prize announcements of research that's been done. It's just astounding. So let me pause just for a second. Questions over here? Anything? Okay. Hey, Keith, how are you? I hope you're feeling better. We got some folks watching the show tonight that have had some medical procedures here in December, and I'm sorry about that for you guys. You know who they are, so you know who you are. Hope you're feeling better soon. So this is what it looks like. AGI by 2027. Well, Elon Musk says next year. Okay, smarter than the smartest human by next year. Anthropic 26 to 27, Sam Altman, that's OpenAI, which is ChatGPT 27, 30. But you don't see anything that's 7, 8 years out here. This is 2 to 3 to 5 years out total. Worst case. Computer power is just staggering. Latest models are, 15 times faster than the current models we're seeing. And again, all this means we still need these data centers. So that while it ebbed off early with that January 27 DeepSeek announcement, it went right back to it when everyone realized, well, this DeepSeek is kind of nice, but it's sort of the Walmart version, if you will. And for people that want deep, serious computational power, you're still going to need to pay the energy to do it. So capital to do it is you're just starting to measure things by $500 billion lots here, $500 billion lots. If it arrives in pink, you can see below, it changes everything. Every industry transformed overnight. I don't even know what that means, but Nobel-worthy discoveries accelerate possibly monthly. Things that were taking years to discover and research. I mean, we could have diseases a year from now on this same show that all of a sudden there are cures for, different types of cancer, maybe, Lou Gehrig's disease, all kinds of things. And it's just really exciting in many ways, and it's scary in others. I get that. So the congressional control battle is my number 4 item. And right now the Democrats are leading in the polls by a lot. And it goes back 8 years to the last time they had this big a lead prior to a midterm election. So GOP defending slim majorities in both chambers. And now you've seen these redistricting wars. Texas, California, Virginia could flip 10 seats. But either way, just because you redistrict doesn't mean you know exactly how those voters are going to vote. So we could see significant swings, and it could work against the Republicans. Obviously, the Republicans want to increase their majority, slim majority, and the Democrats want to overcome that so they can flip at least one of the houses. If they flip one of the houses, very little, if any, legislation is going to get through. So what it looks like here is the House just 5 votes, and actually I think Marjorie Taylor Greene resigned, so that probably was since this was generated. I think it's a 4-seat majority now. Senate remains 3 seats majority. But this momentum shift in the pre-polling showing the Democrats up 14 points is really staggering. So GOP holds both now, but the Dems are licking their chops for a takeover. And we will see what happens on that. Number 3, the stock market split personality. The first half, reflation hopes. The second half, AI-driven surge. Or is there going to be a valuation correction? So Wells Fargo, the K-shaped economy. Wealth effect versus working class. How does this play out? Again, we have more so than at any time I can remember, the divergence between the bull forecast and the bear forecast is enormous. It's a gulf. Haven't seen this in any previous year, I think, in 30 years of doing this. A range from 4,600 to even 9,000. That's crazy, folks. It's not going to be 9,000. All right. I mean, it could the minute I say that, right? If it is 9,000, woo. It's going to be just wonderful for all of us, but even 8,000 would be there. Frankly, if it's at 7,500, it will be. But the point I'm making on this slide is this divergence, and this is one of the reasons why we have changed our risk management strategy, which will be the next segment. All right. So both sides have a point, bears and bulls. We don't know who will win. We'll know by this time next year or sooner. The number 2 event, without a doubt, is going to be the new Fed chair appointment. Jay Powell steps down on May 15th. Good riddance. Kevin Hassert's the front runner. There are other candidates. Will Trump pick someone who is a rate cut champion? We know that he wants to see rates lower, but the Fed members don't just want to be rubber stamped, for what he wants to do. So there's going to be a battle of wills here, I'm sure. All right. So his term ends. We've got a little history here. I think that Kevin Hassard is by far the front runner, although Kevin Warsh, two Kevins there, also has a pretty good chance. The rest of them probably not. If we see a dovish turn in the Federal Reserve, that means that interest rates are coming down. It also means that we have inflation risk. Now, we don't want to go back to this 7% inflation, 9% inflation that we had in the previous administration, for sure. All right. But we'd like to see the growth without that. And with a different Fed chairman in there, that's what we want to see happen. So the number one thing is the valuation reckoning. I've touched on this throughout this overview in the review and the preview section. The question is, with these stocks at these sky high levels, is it different this time because of the underlying business model and the earnings that are being delivered time after time? You're going to see a chart on that in just a few slides here. If it's different this time, then it is highly possible that the revaluation, the reckoning, is going to be in the favor of the bulls. So it's the third consecutive year of 15% gains. Last year, more than that. Unprecedented outside of the dot-com, and we know how the dot-com ended, I should say, but we also know that that was a bogus, I don't want to say liar loan, but it was just bogus because those companies had no earnings and people were just buying a promise. So the consensus 7,500 to 8,000, 10 to 15% would be another great year, not a phenomenal year like 2024. But with all the risks here, midterm elections, valuations, AI bubble, is this a perfect storm? We will not know for some time, but here's what it looks like on the chart. The two possible outcomes, the new paradigm, meaning that history won't repeat itself for all the reasons I just mentioned, all right? Or will history repeat and the market crashes 20 to 50%? I do not see 50, could have hit a 20 like it, hit for just a few weeks, actually just a few days this year, certainly. Will we be positioned for that? We will be positioned for that. That's the next segment. All right. Okay. I'm going to take another quick break here because my voice is getting tired. AGI could find new cures very fast. Yes, it could, Leo. It could also create new problems with unknown side effects also very fast. There's no doubt. Anytime a new technology comes out, certainly in our lifetimes. Now, I'm just going to go back to those of you that are roughly my age. We got a polio vaccination, in the late 50s, right? Stood in line with our parents and got that polio vaccination. I don't know if there's any side effects on that, but it just wasn't as complicated as COVID and all these other technologies. And I think that's what Leo's referencing here, is that anything this powerful is bound to have challenges. Anybody else with questions? About a 20-second delay on this. So if you got a question, just pop it in there. So you guys see this every time I do a show. I put it in this separate segment here. We're killing it, guys. We're just killing it. So we're 493 of the S&P 500 have reported third quarter earnings. Remember, once we hit January, we'll report fourth quarter earnings, right? We'll look backwards. But financials, healthcare, industrials, technology, all of these just killing it. All right, the two factors that make the most difference in the returns in your portfolio are interest rates, where we just spent a ton of time, and earnings. And everything you can see right here is that earnings are beating their projection. 83 is way above the historical norm. It's right there on the page. 83 well above the 5-year average beat rate of 73%. This is going to be a fantastic quarter looking back. Now, here's an unusual economic development. Apple is having a mass exodus, and this is what happens when you're riding on your laurels, my opinion, okay? And you slack off with AI, and now they're losing a key executive almost every week, or certainly 3 a month. And the chart here just shows what that looks like. Going to Meta, other AI, other unknown or retired or whatever, but a ton of them going to Meta. So Apple needs to get its act together. Why do we care? Because they're a $4.3 trillion company. And they haven't released a truly innovative product in more than a decade. That just shows how powerful their ecosystem is. And we're on that ecosystem: Macs, iPads, phones, glasses, etc. So we'll see how this plays out. I want to show this again. We already talked about the Fed, but this is what it looks like. They plateaued here up at 5.25, and it's came down, and then they paused again, and now 3 stair steps down. I think the next move is another plateau there for 2026, and then continuing to drop from there. All right. So one phrase that was a trigger for me in their announcement is that the phrase extent and timing regarding additional rate changes. That's a way of saying we're not in a hurry to do anything more. We gave you 3. We can make a good case that that's all this market needs now, unless there's a serious hint of a recession. And right now, there is not that in place. So the Fed signals a pause, and they were going to navigate data darkness. I like that phrase. I didn't make it up. It's pretty cool. Data darkness. That's what they had for 43 days. And it's not like, oh, the government's back at work and now all the data's there. No, they've got to go back and get the data. And oh, by the way, there's all kinds of new data coming in at the same time that has to be processed. So it's really complex. That's why I said really it's going to take till that first Friday in January and really the end of February to get a full month's full cycle of December data, because the market, the government obviously has been open all of December. So that's really what this data darkness is, and what the Fed is saying is, it's just going to take us a while. This missing government data leaves the Fed navigating policy decisions with reduced visibility into the economy's performance. They are projecting GDP, that's gross domestic product. You can see that it's September projection, and then the December dropped a little bit, the red dots, but still 2%. I mean, I'd like to see 3. I'd like to see 2.5, but 2 is still respectable. It is just matching inflation, though. I mean, that's why if growth is 2 and inflation is 2.5 or 2.75, that's not good. Unemployment rate is coming down in their projections, right? Those are the dot plots, so to speak, coming down to around 4%. And another big item on the economic, calendar is that I showed you the new guy, Greg Abel. Okay, there he is. He is replacing a 6-decade leader of Berkshire Hathaway, the most famous investor in the history of the world, at 95, 25 years my senior, is saying it's time. And he said, I'm not doing any more meetings. I'm not going to go on CNBC. I don't know if he's going to play golf. I would be surprised, frankly, if he's not around that much longer, because this is all he's known for more than 6 decades. But it's the changing of the guard at Berkshire Hathaway, and that is definitely something we'll be watching in 2026. So let's talk just a little bit about risk management and what we're doing. So our current hedging strategy uses SPY and QQQ put options expiring March 20. So let's just dig into that. What does that mean? So SPY is an acronym for the S&P 500. QQQ is an acronym for the NASDAQ. These are put spreads. A put spread, especially long put spread, which is what we're using, hedges to the downside. So what this means is we are now long and short in a portfolio. So we are gaining when the market goes up, and we can gain some when the market goes down. Well, we're not trying to, make a ton of money when the market goes down. We're trying to protect the gains we've made on the long side. That's why it's called a hedge and not short trading. All right. A lot of people, and I'm going to go back on camera. A lot of people have said to me, when I see options and I'm signing up, it makes me nervous. Okay. Well, don't be. There are 2 ways to play options. First of all, I said all of this in the last November and October shows, so go back and watch those. All right. We are playing the other side of the market, which is the hedging side with options. The people on the floor are selling us these options, and they're taking the risk, and they're getting paid for that. Okay. So we pick the strike levels where we want to be, and we're picking them, as I said in my previous videos, at the 2nd and 3rd standard deviation. So it provides downside protections in the case of the S&P 500 in that $620 to $560 range. Now, What does that mean? That's the price of the SPY ETF. So there's an ETF, an exchange traded fund, that trades the S&P 500. We don't use it, but it's a benchmark. So we have stocks in CG, GI, and QQQ and TS that all trade S&P and NASDAQ and small cap stocks. This is an interesting point because I had a client say, well, gee, I'm kind of wondering why there's not as much hedging going on. This is a pretty astute client in the CG program now. And I said, well, there's a reason for that. And that is because we have 3 programs. We know that the SPY options, the S&P 500, are working great in GI because everything in GI is an S&P 500 stock. It's a conservative program. And everything in DS is a NASDAQ stock, almost everything. All right, so the QQQ, which are the NASDAQ options, work great. But CG almost needs a synthesis of SPY and QQQ. That's in testing right now, and expect to hear more about that on the January show. Why is this important? Because this technology, these strategies, have not been available until we moved everybody. After 16 years at Interactive Brokers, we moved everybody to Schwab, and we can now implement these institutional grade hedging strategies. All right. So what's the trade-off? Portfolios remain unhedged below this 560. So this is not infinite downside protection. It's limited. I'm going to give you graphs in just a minute so you can see how this works. It covers the most likely downside scenario. So if it were free to buy these options, we would be a lot more aggressive with them. But realize it's just like a homeowner's policy. When you insure your home and it burns down, the insurance company doesn't replace everything. They might even allow you to build a new house, but you're going to lose all of grandma's pictures, all your housewares, the dress that you bought in Paris. They can't insure everything of value that has been taken from you by this fire. All right, so we're trying to protect against the very worst downturns in the market with these options hedging strategies. Here's what it looks like on a chart. So we kick in the middle chart. You can see, so on the left-hand side, the SPY today closed around 687, I think, a little bit higher than where it is now. And so the options are just waiting there. They're not doing anything. In fact, they're actually losing a little bit of value because there's something called theta. They decay, but that's okay because our stocks are making money for us. But when the market does sell off, you could see we head down into that protected range. And so we are fully protected there at that point. Now, that doesn't mean it's dollar for dollar. It starts out at being 20%. And then as the downside increases, we talked a little bit about the Greeks in the previous show, and this has to do with Gamma and Vega. Those increase and give us anywhere from 20 to 35% downside. Again, it's not going to be 1-for-1 because if it were, then when the market turns around like on April 9th and rockets to the upside, you're going to make nothing. Okay. So I'll continue to cover this as I continue to get questions from you on wanting to understand why and how we're doing this. The last shot here, you can see it actually pierces the lower side. And at that point, we would need to bring in extra hedging. That is a 3rd standard deviation move. Now, I used the bell curve in previous presentations. Go back and I think watch not November, but October's show. What is it, 67.4% of all occurrences, that's the 1st standard deviation, and then there's another 20-something percentage, and it covers 95 roughly percent of all the occurrences in the market. But there are those outliers, and that's when we have to be nimble, like 2008, 2002, and adjust that hedge so that we continue to have protection to the downside. But that's a manual change. The way these options work is they go into your portfolios 4 times a year. Every February, every May, August, and November. And they roll consistently, and we move them up or down depending on where the market has moved in the last 90 days. Okay, there you go. So this is another view of what's happening here. So on the right-hand side, the market's going up, and you can see the dashed gray line. That's the actual market, and we are the green line. So we may not be making quite as much as the market's making because there is what's called a lag or a drag on the portfolio from the cost of the options. But then if there's a downturn, we put the brakes on there at 620 because that's where our current long put is. And we're protected for 60 points in the S&P. That's a lot. That's about a 20% move. All right. And then after that, there's a floor where we just don't get any more protection unless I go in and change the ballistics, if you will. And if that happens, it's not if, it's when it happens, I will be on the show. And I may even do a special show off my regular schedule if the market does have a downturn and some of these predictions are wrong and it really is an ugly year. But we're positioned for it, folks. We are positioned and we're ready for it. So summing this up, the real challenge this year, as I mentioned earlier, is this 4,600 to 9,000, 40% swing. I mean, I just want you to look at this when I put it back on the screen again, a 40% variance in the major Wall Street houses as to what the predicted outcome is for the year. It's crazy. All right, the 4 pillars of our risk management framework. We just covered the first one, options hedging. For the next 3, you're going to need to tune in, I should say, in January when we will cover these. All right. People have said to me, where can we see our performance? I covered this last time. I'm going to do it one more time here. And then after this, you'll know how to do it. So you go to our website, you click the word performance at the top. All right, it'll take you to this page and you will see our 3 programs at the bottom, and you'll always see the most recent month that's closed. So you're not going to see December here because December's not closed yet. We try to post it. We've been pretty consistent getting it in within the first 6 to 7 days. There's calculations that need to be done. So you click the November DS and here's what it looks like. All right, so year to date, 8.7% in DS because of some of this volatility that we've talked about. 5-year track record is really strong, and the total return since inception, 420%. Also really strong compared to the S&P, right? If you go back 7.5 years, we have a pretty long track record now. Now, something that you might say as well, okay, but what is it doing now? If I just want to know from today, well, that's when you go to your Schwab account and you go to this page and you set the calendar, because obviously you have the performance through November, and you can just set it from 12/1 to 12/11, which is today. And you can see that it's up about 5.25%, where the S&P is just up, I don't know, less than 1%. So you have to add that to this performance. The year to date there you can see is 8.7. Now it's not exactly mathematically accurate because of compounding. So if you really, really, really want to know how you're going to do in December, you have to wait for the December performance. But you can add those 2 together and get a rough idea. And that works for all of the programs. If you have a question, call me on it, send me an email. But that's how you can at any time know exactly where you are performing. If you are new to the show, please subscribe to us, tick the little bell, listen to us on Facebook. Watch us, I guess I should say, on our YouTube channel, and then watch the tweets, right, on Facebook, X, and LinkedIn. Next show, Thursday, January 8th. It's the earliest possible date. So January 1st is on the first Thursday and January 8th is on the second. That's the earliest it can possibly be for the year. I'm still podcasting, not every single week because it doesn't seem like you guys are listening that much. Let me know if you really enjoy them, and I will go back to doing them every week. But sometimes I cover so much on the monthly show that it's just redundant. So, all right, few sayings I want to leave with you. If you don't bet, you can't win. But if you lose all your chips, you can't bet. All right, Larry Hayes. I like to bring these quotes of famous traders. Jim Rogers, wait till the money's lying in the corner and all I have to do is go over there and pick it up. Well, that's great. Now, you guys know this. Stick with me because, as you know, this is the December show, which means we have a special bonus at the end. For we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. It's become a tradition now to play the following video for you. It has a special significance to me. Those of you that have seen this totally remember why that's the case. If you are new to the program, it will be new to you, and you will see why this is something that a portfolio manager might want to gravitate to. Not so much last year when things are just going great, but this year when it's been difficult. It's good to remember that sometimes it takes multiple tries and honing and making sure that you're doing everything you can to make our process better. And in the end, it turns out in a beautiful way. And this is a story that I think you will be able to relate to. I certainly do. I'm sure you can see why I love that story. And I hope it meant something to you. And I hope that if you're struggling a little bit at this Christmas season, that you will continue on. I know some of you on this call have some health challenges, some pretty big health challenges, but hang in there because God's got a reason to keep you here. And you might have to discover what that is. Maybe there's a change of course. But in this wonderful time of year, remember what the reason for the season is. I want to thank each of you watching this program, either live now or later on the replay. You all mean so much to me. Allison, I never take you guys for granted. It has been our honor to serve you these last 25 years. And God willing, it'll be for another many years to come in the future. And that's a wrap on 2025. Merry Christmas and Happy New Year to all of you. Happy Hanukkah. We will see you next year. God bless. Take care. We'll see you soon.